Welcome to the Opening Bell Report.
Today, we are looking at a chart that, well, honestly, if you have this in your portfolio, it probably hurts just to look at it.
Oh, yeah.
We're talking about the classic boom and bust story of the last year, supermicrocomputer, or SMCI.
It is the textbook definition of a roller coaster ride, or maybe just a drop tower at this point.
Seriously. I mean, we've covered the AI hype cycle from pretty much every angle. We watched SMCI become the absolute darling of Wall Street.
It was untouchable, the sidekick to NVIDIA.
And then gravity took over. The stock has been absolutely hammered down to around $29.71.
A brutal, brutal correction, and a very fast one.
So the question on everyone's mind, and the question we're going to explore today is, well, it's simple, but the answer is expensive if you get it wrong.
Mm-hmm.
Is this a falling knife you should stay a mile away from? Or are we looking at the sale of the decade? Because we have an analysis report here that's taking a very bold stance.
Bold is definitely the right word. While a lot of the market is, running for the exits, this report is filing itself under aggressive and contrarian.
So they're saying everyone else is looking at this wrong.
Essentially, yes.
Okay, let's hit the headline numbers right out of the gate so everyone knows the stakes. This report isn't just saying hold. It projects a target price of $36.
Which, if you're doing the math from where we are now, at roughly $29, represents a 54% upside.
That is massive.
It's huge.
Especially when the sentiment is this negative. So our mission for this deep dive is to unpack why. Why on earth does this report believe the market has gotten this so wrong?
Is it actually a coiled spring ready to pop? Or is it just wishful thinking?
Exactly. Because, look, everyone loves an underdog story, but I need more than a good narrative.
And that's where I have to step in. We can't operate on hope. This deep dive has to be about cold, hard numbers and, interestingly, market psychology.
We need to see if the math supports the narrative.
Precisely.
Okay, let's unpack this. The report starts by talking about market psychology and this idea that the stock is oversold. Now, we hear that term a lot. It's oversold by the dip.
Right. It can be a cliche.
But what does that actually look like in practice here?
So the core concept is the shift in expectations. Think back to early 2024. SMCI was priced for perfection.
Meaning the stock price assumed everything would go right forever.
Exactly. High margins, endless growth, no hiccups. An impossible standard.
Which, in the hardware business, is basically fantasy.
It is. But now, the pendulum has swung all the way to the other extreme. The report argues that SMCI is now priced for failure. The market is assuming the worst-case scenario is the only scenario.
It certainly feels like the market is punishing them. But here's my question. How do you know when the punishment is over? How do you know you're at the bottom?
That is the million-dollar question. And this is where the report introduces a really interesting theory called bad news saturation.
Bad news saturation. I like that. Break that down for us.
Okay, think of the investors in this stock like a sponge. For months, we've been pouring water on it. Accounting concerns, margin compression, short seller reports.
All the negative headlines.
Right. And now the sponge is soaked. It's completely saturated. So if you pour more water on it,
it just runs off. It can't hold anymore.
Exactly. The report suggests we are seeing clear signs of this right now. We've had negative headlines, yet the stock is refusing to break below that $29 mark. It just stops reacting.
It's like a boxer in the 12th round who's just gone numb.
That's a perfect analogy. The boxer has taken so many hits, they stop flinching. And in the stock market, when a stock stops going down on bad news, that is often the strongest signal that the selling is, quote, exhausted.
So the sellers have run out of ammo. Everyone who wanted to sell out of fear.
They've already sold. The people left are the ones who aren't going to panic. And if the selling is exhausted and the consensus target is $46, it implies the market has severely overcorrected.
Yeah.
It's an emotional reaction.
Not a logical one.
Right.
Okay, so emotionally, the market might be tapped out. But let's talk valuation. Because usually when a stock drops this much, people call it a value trap. It looks cheap, but it's cheap for a reason.
Absolutely. And that is the risk. But the report uses the price-to-earnings ratio, or PE, to argue this is a bargain. And the comparison to just a few months ago is pretty wild.
Remind us what the PE was back in the glory days of the AI frenzy.
At the absolute peak, investors were paying 45 to 50 times earnings for SMCI, a massive premium.
50 times earnings, that's lofty. That's pricing in world domination.
It's priced for hypergrowth. But today, you can buy that same exposure to AI infrastructure for about 24 times earnings.
Basically half off.
It's a drastic shift. And here's the key part of the logic. This is the normalization argument. This really caught my eye.
Okay, lay it on me.
The report says SMCI does not need to return to that crazy hypergrowth mode to justify the current price. It doesn't need to be the darling of Wall Street again.
It just needs to stabilize.
It just needs to stabilize. We are significantly lowering the bar. If SMCI just settles at a standard tech hardware, multiple say 20 to 25 times earnings.
The current price around $30 is fully supported.
Exactly. It doesn't have to go up to justify where it is. It just has to exist.
But the target is $46. That requires it to go up.
Right, and that's where the upside trigger comes in. If growth reignites even a tiny bit, let's say the multiple expands back to just 30, not 50, just a reasonable 30.
That instantly validates the $46 target.
It does. They don't have to hit a home run, they just need to hit a single, and the stock re-rates. The bar for success has been lowered so much that just stepping over it yields a 50% return.
That's a compelling argument. But markets need a catalyst, right? Value can just sit there for years if nothing pushes it.
True. A value trap is just a cheap stock with no catalyst. You need a reason for people to look at it again.
So the report mentions that the wait-and-see period is ending. Why now?
They identify two specific triggers, and the first one ties directly into the biggest name in the game, NVIDIA.
Of course. All roads lead to NVIDIA. What's the connection?
It's more technical than just NVIDIA does well. It's about the Blackwell cycle. NVIDIA is ramping up their new Blackwell chips. They're absolute beasts, but they have a catch.
The catch is heat.
That catches heat. The power density is off the charts, and this is the crucial detail. For Blackwell, liquid cooling is described as mandatory, not optional.
Mandatory, that's a strong word.
It is. You can't cool these racks with just fans anymore. The physics just doesn't work.
And let me guess, SMCI is the liquid cooling specialist.
It is their specialty. They've been doing it longer and better than almost anyone. They were pushing it years ago when everyone else said it was too complicated.
So if you want the best chips, the Blackwells, you literally have to buy the cooling systems SMCI builds.
That is the entire thesis. The report expects the backlog for these systems to hit the revenue stream in Q3 and Q4. The orders will turn into cash.
Okay, so that's trigger one. What's the second?
It connects back to that psychology. A trend reversal on margins. The market has priced in a complete collapse of their profit margins.
They're raced to the bottom.
Exactly. But the report asks, what if the margins just don't collapse? What if they just stay flat?
Then they beat expectations and the entire bear case falls apart.
That's the idea.
Now, I have to play devil's advocate here. Whenever I talk to people about SMCI, the counter argument is always one word: Dell.
Ah, yes. The Dell argument. It's unavoidable.
Dell is the safe play, right? The big, stable giant. Why risk it with SMCI when you can just buy Dell?
And the report agrees. Dell is safer.
Okay, so why not just park our money there?
Because safer usually means capped upside. Dell trades at about 15 times earnings. Everyone knows Dell is good. It's priced efficiently.
You're buying a known quantity.
Right. But SMCI is described as having higher beta. In simple terms, that means it has more leverage to the upside. If the AI sector goes up 10%, a stock like this might go up 20 or 30. It's a coiled spring.
Hold on to your hat.
Basically. And there's another piece to this: time to market. Historically, SMCI always commanded a premium because they're a speedboat, and Dell is an aircraft carrier. They can build a custom server in weeks.
But right now, the stock price is acting like that advantage is gone.
Vanished. The thesis relies on that premium returning as Blackwell rolls out. When speed is everything, you call SMCI.
Okay, so we have the fundamentals, we have the catalysts. Now I want to shift to something I usually struggle with:
Let me guess.
the charts.
Squiggly lines. To me, it often looks like reading tea leaves. But this report has a whole section on it, and they seem convinced.
I get the skepticism, but the levels they point out are pretty distinct. They argue the floor is in.
A concrete floor.
That's the term. They identify the $28.80 to $29 zone as major support. Every time it dips there, buyers step in.
So the big money is setting buy orders right there.
It seems so. It's a sign of institutional interest. But then there's this other term, bullish divergence.
Okay, that sounds complicated. It's a really powerful signal, actually. Think of it like this. The stock price made a lower low recently. But the momentum indicator, the RSI, made a higher low.
So the price went down, but the energy underneath went up.
Exactly. The downward pressure is losing steam. The sellers are getting tired. It's a classic sign that often precedes a trend reversal.
Okay, so the selling is running out of gas. Is there a specific number where we say, okay, the rocket is taking off?
The report is very specific. The breakout point is $31.50.
$31.50. Why that number?
That's the 50-day moving average. It's a key technical barrier. If SMCI breaks above it, the report says there's very little air until $40.
Very little air, meaning no resistance.
No resistance, no clusters of sellers waiting. So the move could be, in their words, fast and violent.
Fast and violent upside. I think listeners are perking up at that.
It goes back to that coiled spring idea.
All right, before we wrap up, let's do the napkin math. How do we actually get to $46? Is it magic?
No magic, just arithmetic. Current earnings estimates, or EPS, are about $1.24 per quarter.
Okay, so annualized, that's roughly $5 a year in profit per share.
Right, $5. Now let's be super conservative with the valuation multiple. Let's pretend the market hates this stock and only gives it a 9 times valuation.
Wait, 9. We were just talking about 24 or 30. 9 is incredibly low for tech.
That's the point. It's rock bottom. But even at 9 times on that $5 of earnings, you get $45 per share.
Wow. So the math works even if you're pessimistic about the valuation.
Correct. The report emphasizes that to reach $46, SMCI doesn't need to invent some new product or conquer the world.
It just needs to keep the lights on and sell the servers they already have orders for.
Execute on the backlog, stop the margin bleed, and the math works. It's a reversion to the mean.
It's not a moonshot. It's just returning to average.
An average, in this case, seems to be a lot higher than $29.
So let's bring it home. This report puts an aggressive BUI on SMCI. But we need to be responsible. We aren't financial advisors.
Absolutely not. And we should reiterate the risk profile. The report marks this as high risk. This is a volatile stock.
This isn't a savings bond. You could lose money.
You could, but the argument is about asymmetry. At $29, the downside seems limited by that floor, while the upside to $46 is over 50%.
The risk-reward is skewed in your favor.
That's the thesis.
So the takeaway for you, the listener, is that this is about spotting opportunities where the market might be reacting to fear, not math.
It feels uncomfortable to buy when everyone is selling, but if the numbers hold up, that's often where the real money is made.
Before we sign off, I want to leave you with one final thought to chew on. We talked about liquid cooling being mandatory.
The key technical detail.
If that's true, and SMCI is priced for failure, are we looking at a situation where the infrastructure plumbing of AI, the boring stuff like cooling, is currently undervalued, while the chips themselves might be overvalued?
It's the classic picks and shovels play. Everyone is watching the gold, the GPU, but without the shovel, the cooling, you can't get the gold out of the ground.
Exactly. Something to think about as you watch that $31.50 price level. Thanks for diving in with us today.
My pleasure.
We'll see you on the next deep dive.
Don't forget to like, share, and subscribe for more.